There's different ways that different people do it. One, it's hard, right? Playing goalkeeper is a lot harder than people think. Right? Investing in a sense, time is the main dichotomy. When you invest in something, time's your friend, right? You accrue the earnings, the coupon, the dividend, and each day as the duration of that gets shorter, your risk gets less. And so investors do most of their work before making the investment. And then once they've made the investment, they move on to something else to, further diversify the portfolio. But when you're on the other side of that, time's your enemy, right? When I go out and construct a convex liability structure, so in a sense, I'm managing liabilities, and there's a cost with that, and my sensitivity, my asymmetry to some outcome gets less every day. It starts, at its peak, and then tomorrow, there's theta, there's decay, there's et cetera. And so, it's a constant beast, to play goalkeeper. When you've committed that your job is at the end of the season, you're going to be, end of the year, you're going to be a bigger, stronger goalkeeper than you were at the start of the year, despite the fact that what you own is naturally losing strength and sensitivity every day. And so people go about it different ways in different markets, and because the nature of tail events is very path dependent. I always use the forest fire analogy. In a forest fire, only one tree starts on fire because of the lightning strike. The risk to the system is the contagion as the fire spreads from one tree to the next. Every other tree catches on fire because of the tree next to it. And so every forest fire is the same in that sense, but every forest fire is different. How it starts, when it starts, where it starts, how it spreads, which direction the wind blows. The similarity, and in a sense what our task is to go and find the parts of the forest that have the most dry tree and brush, right? Because the actual risk isn't the exogenous probability of a lightning strike. It's the endogenous risk of how much combustible material is built up on the ground. And so, the again, Sharp World value at risk says, well, the last bad fire was caused by a lightning strike. So we're going to build a model that predicts the probability of a lightning strike, and says because there hasn't been a lightning strike for a long time, there's not likely to be one. Right? And so everyone's got their models pointed up in the sky predicting lightning, and then all of a sudden the forest catches fires because kids were playing with matches. And they all say, well, nobody could have seen that coming. Meanwhile, the exposure to super senior tranches of subprime CDOs with no capital backing any of the correlation risk embedded on them is staring them all right in the face. Just the regulators and Sharp World risk accounting doesn't make you account for it. And so the fiduciary, who has no skin in that game, has none of the downside, is happy to continue to pocket the levered carry component of that and ignore what the actual risk is. And so the way we construct what we do is we embed ourselves in the implicit leverage of volatility selling, and just help people recycle that when it's piling in on something because every German pension fund is doing Bermudan swaption embedded callable note structures. The banks have more than they can possibly get rid of. And as it turns out, and don't tell anybody because this is truly the secret sauce, as miserable and hard as being the goalkeeper is, of being the insurance provider in an industry that doesn't want to pay for insurance. Yeah. The one good thing is the biggest risk, the biggest accumulation of dry brush and dry trees in that forest lines up with where the insurance is the cheapest. Right? Because it's that application of the leverage that is sort of the interconnecting dry brush between the trees, right? So the best hedge for the GFC, or one of the, well, probably actually wasn't the best hedge, but we can come back to that later. Super senior tranches of subprime CDOs. When were they the best hedge? Well, when they were trading the tightest to U.S. Treasuries. Why were they trading that tight to U.S. Treasuries? Because banks had managed to construct them as zero risk-weighted assets and could lever them infinitely. as such, at exactly the time they were priced as the least risky is exactly when they were the most risky. And then as soon as that correlation adjusts even moderately, it wipes out all of the capital in the banking system. And it's, you know as well as anybody, it's not like the banking system was unregulated. It's exactly the opposite, right? It was just wrongly regulated. And so that's what we do. And we're very agnostic. My simple question always has been, what if it works? Right? What if, after whatever undefined period of zero interest rates, negative real rates, endless QE, what if it finally works and you decide you want to reverse it? Is it not inevitable that you would have built up the greatest imaginable sensitivity to rising interest rates the world has ever seen? Obviously, right? If you couldn't foresee where this was going, I have to wonder what you know about economics, financial markets. What do you think they're trying to do, right? The persistent, solving a credit problem with more credit is going to end up with a credit problem that needs more credit, or, and so, Japan takes that to a maximum extreme. And as I wrote about, I've been writing about Japan for I don't know how long. I dubbed it the most dangerous peg in the world back in March of last year. And it's the most dangerous peg in the world because, one, it is the grandfather of structured product activity, right? It's the first place where interest rates got really low and a large household savings pool out searching for yields. And anything and everything you can imagine in terms of exotic bells and whistles has been done in Japan on every asset class domestically and globally for 30 years. And nothing is more, that stuff is sensitive it is to Nikkei or dollar yen or CLOs in the US. It's maximally sensitive to Japanese interest rates. That's the whole point in being. And every single one of those structures is sensitive. The present valuing of it is sensitive. The optionality is sensitive. The row of the embedded options is sensitive. The forward price of 25-year power reverse dual currency bonds and the correlation is sensitive, right? It's all sensitive to interest rates. And so you have this, I describe it as the canopy of a tree. If you think of the canopy as the derivative overlay of activity in the market and the trunk as the underlying market, well, the trunk in this example is the JGB market would look like a toothpick, right? Compared to the scale of the derivative activity that has developed over the years, and particularly in the last, decade under Kuroda, where the central bank has taken out most of the underlying market, the JGB market, and put it on their books. It doesn't trade anymore. The JG market basically hasn't traded for years, other than the dance where the finance minister issues on a Tuesday and Bank of Japan buys it on a Wednesday, and the banks sit in between for a basis point. Right? And they call that not directly monetizing the debt.